Welcome to A Policy Brief, the podcast where we break down complex public policy issues and explore how they shape our world. I am Eromosele Alenkhe, your host, and today we're diving into one of the most dynamic and controversial topics in finance and technology, cryptocurrencies. And to be exact, the US crypto landscape, what you should know. Whether you're a crypto enthusiast, a skeptic, or someone just trying to understand what all the buzz is about cryptocurrencies, or digital assets, as some people like to call them, this episode is for you. And we'll explore three things. The first one being the current state of crypto regulation in the US. We'll cover topics like the SEC's dramatic policy reversals to Wall Street giants like BlackRock now holding billions in digital assets. We'll also cover the challenges policy makers when regulating crypto in an era that's now being referred to as the great normalization of crypto. And finally, we'll look at what you need to know about the future of digital assets from a public policy perspective. Let's get started. Before we delve into today's topic, let's come to terms with why it's important and ultimately why you should care about it. Now, 16 years ago, and I chose 16 years because that's when the Bitcoin white paper came out. If someone had asked you to imagine a future where your regular everyday financial transactions, such as payment for your groceries, clothing, tuition, could possibly involve not the use of cash or credit card or debit card as is commonplace today or back then, but with the use of a central bank digital currency or a digital currency alternative like stablecoins such as USDT or USDC, your answer to that question 16 years ago will probably be, well, that's very unlikely, except you're like me, who believes in the possibility of a dystopian future. Now, today, if you were asked that question, your answer to that same question that I would have asked you 16 years ago would be very different in the sense that even if you're a skeptic, we now have the technology and the necessary interest to transition into a world where the use of digital currencies is broadly used. And for things like payment systems and the likes, the interest is at an all-time high. Now, experts anticipate a transformative financial future where things like the central bank digital currencies issued and regulated by a country's central bank, or the use of a stable coin by countries who are hesitant to get involved with CBDCs. The narrative right now is that digital currencies could in the nearest future serve as the backbone of our everyday financial transactions, offering things like enhanced security, transparency, and efficiency. Now, a major point of reference for those who are, I would say, bullish on the idea of a widespread use of digital currencies is the significant improvement in things like cross-border payments, which have historically been hindered by high fees, lengthy processing times, and numerous steps involved in the whole cross-border payment system. With cryptocurrencies or digital assets, these cross-border transactions could become instantaneous and greatly benefiting international trade and allowing businesses in open economies to thrive. And as they improve the access to global markets for these countries and the businesses in them, we'll see a sort of breaking of the traditional barriers that banks have imposed on certain economies. And it's not as if banks do this thing directly, but it's just how the system is today. However, it's important to point out that the promising future that we tend to see, or is tend to be touted by people who are bullish on the idea of digital currencies, is not without its challenges. A few of these challenges include privacy concerns. We have cybersecurity threats and the potential for increased government oversight, or some would say surveillance, on citizens. Now, for many of these challenges, they're very important questions that society should start to ask even now and I think tomorrow. How would we as a society manage the adoption of cryptocurrencies or digital assets into the existing fabric of traditional finance and by extension into our everyday lives? This is particularly important because of the increasing adoption of crypto by major traditional finance players. Now, these were the same people who went around saying crypto was a scam, they wouldn't touch it in the early years of crypto. Now we have a lot of ETFs, for crypto and Bitcoin springing up everywhere. So you have to ask the question, why the sudden change? Now, and the significant interest in central bank digital currencies, also known as CBDCs, by most central banks globally. Now, it does require policymakers and citizens to investigate the likely impact of this new technological innovation and what it entails when we adopt this, which is very soon, likely. What does this mean? Now, I came across this paper when I was writing my thesis, and it has a lot of silent points that I would like to that are very important that I would like to highlight in trying to make the case as to why this is important for us. And this is a BIS paper. Basically, if you don't know the Bank of International Settlement, they're like the central banks for central banks, right? So this is a BIS paper. It's a number 136, making headway results on the 2022 BIS survey on central bank digital currencies and crypto. Now, just quickly go to page 19, which has the good stuff, which is the conclusion, and I'll summarize from there. So now, the Bank of International Settlements, the BIS, has documented a sharp rise in global central bank interest in central bank digital currencies, CBDCs. According to the BIS 2022 survey, 86 central banks, 93%, reported being engaged in some form of CBDC work. The survey found that almost a quarter of these central banks were piloting a retail CBDC, and more than 80% saw value in having both a retail CBDC and a fast payment system, for fast payment system, basically citing unique features and additional benefits of CBDCs. Now, not to worry, I'll explain or just silently touch on the difference between a retail CBDC and a wholesale CBDC. Now, looking ahead, that the BIS survey suggests that up to 15 retail and 9 wholesale CBDCs could publicly circulate by 2030, when 2025. That's 5 years from now. The likelihood of issuing a retail CBDC is generally high, and this is what the paper concludes, is generally high among central banks in emerging markets and developing economies than in advanced economies. And the probability of wholesale CBDCs issuance in the short term has doubled compared to the previous year. So the wholesale, you're likely to find that in advanced economies. And this is a 2022 survey saying the chances of having that issued by advanced economies has doubled. Now, the growing engagement is confirmed by the BIS and the IMF reports, which note that the proportion of central banks exploring CBDCs has risen to 94%. That's 94% of central banks globally, with several large economies dedicating significant resources to retail CBDC projects, such as the digital euro and the digital pound. Now, the BIS Innovation Hub, they have a fantastic innovation hub at the BIS, and they're monitoring the research and piloting projects by different central banks globally. Now, to provide context for what a retail CBDC is and what a wholesale CBDC is, and it's a mouthful, CBDC, yes, I know. Now, the distinction really between the retail and the wholesale has to do with the target user, has also to do with the use case and the design objective of the CBDC. Now, for retail CBDCs, it's typically designed for the general public, for businesses, for households, functioning as a digital equivalent of cash. Now, you have examples as the Nigerian e-naira and the Bahamas Sand Dollar. These are early adopters of the retail CBDCs. Now, it's aimed to improve financial inclusion, and that's why the survey noted that you found a lot more retail CBDCs in emerging economies as opposed to advanced economies. Now, the wholesale CBDC is restricted to financial institutions such as banks and clearinghouses for things like interbank settlements and security transactions and liquidity management. So wholesale more likely to see in advanced economies restricted to financial institutions for settlements, and retail is the digital equivalent of cash for the general public, businesses, household, and the likes. So now we'll silently transition to looking at institutional adoption and what that's been like. For context with institutional adoption, I'd like us to focus on this. Today, the global crypto landscape looks very different from what it did in the early days when the concept of Bitcoin was first introduced in 2008 through the publication, the Bitcoin white paper by the person we now know as Satoshi Nakamoto. The paper was titled a peer-to-peer electronic cash system. And this white paper outlined a revolutionary vision for a decentralized currency free from government or institutional control, and that's why a lot of people flocked to it. And this document not only introduced groundbreaking concepts such as the blockchain technology, but it also sparked a global movement that would challenge and revolutionize traditional finance and technology, leading to breakthroughs and some would say practical applications in the areas like in different areas like supply chain management, smart contracts, decentralized finance. Like fast forward to today, and crypto's adoption has evolved beyond using digital assets such as Bitcoin to buy pits as a test case. Now, financial markets and central banks have taken notice. They've all taken notice. And you have institutions like Goldman Sachs and JP Morgan offering Bitcoin related services, the ETFs that you see everywhere now. We have countries like El Salvador adopting it as legal tender. You now have central banks exploring, possibility of issuing digital currencies, in response to the growing influence of crypto. Also, I like to use AI and, just to provide a brief snapshot of what, crypto looked like 16 years ago and today. And just to compare, now you have Bitcoin 16 years ago probably was around zero. Now it's $105,000 for one. And that's pretty, crazy if you think about it. So market capitalization was basically zero 16 years ago. Now it's about 3.4 trillion. And we're not even in the bull run for the crypto sector. You have numbers of, well, you had one Bitcoin then, now you have about 16,000 or thereabout. And I think there's a halving coming in very soon. You have, no formal exchanges back then. Now you have a lot of exchanges, and you also see the estimated global user base of over 860 million people. Now that's proof. If you need proof of concept, that's proof that this is something that has grown exponentially and you need to take serious. Okay, you also look at institutional involvement, major institutional investment. You have ETF approvals and integration into the ecosystem. This just gives you a snapshot of what it looks like. Yes, we'll just stop here. And I think, I just read the summary because I found it particularly interesting. 16 years ago, crypto, what some people like to call digital currencies, was an obscure experiment with no market value, with no exchanges, and almost no users. And today, the crypto market is a multi-trillion-dollar global asset class with thousands of coins, hundreds of millions of users, and deep integration into the financial system. You mentioned Bitcoin. It's just an example of a currency. Bitcoin remains dominant, but the ecosystem now includes stablecoins, DeFi, which is decentralized finance, and a wide array of blockchain-based applications. Also, the crypto ecosystem has expanded to include innovations like smart contracts popularized by Ethereum and stablecoins such as USDT and USDC, which bridge the gap between crypto and traditional finance. Even political figures have embraced crypto. For example, President Donald Trump has shown affiliation with the space, launching his own NFT collection, meme coin, and expressing support for cryptocurrency innovation. And I think this is probably why we now have, the executive order on crypto, which I will come to much later. And so now you can see that the journey from what I would say, a single pizza transaction when Bitcoin came out to what you can now see as a multi-trillion-dollar market underscores the transformative power of the crypto landscape and, its enduring impact on the global economy from zero to being something that's now over 3.4 trillion in market cap. Now, just to provide a quick summary of the journey so far for crypto, because we're trying to provide some foundation for the journey so far for crypto. It can be broken into, I'd say, like 3 phases. And, you can see from the initial reaction from traditional finance and central banks, to cryptocurrency, it was largely skeptical and dismissive, like, yeah, that's probably like a scam, or they didn't really want to touch it. But initially, the initial reaction, when I would start like the first phase, the initial reaction to cryptocurrency was largely negative. It's driven by skepticism, concern about and regulatory uncertainty. Now, second phase, you have like over time perspectives started to evolve and change, and we had increased recognition of the potential for blockchain and the technology and what it could do, and to the need for regulatory frameworks for cryptocurrencies and digital assets. Now, the third phase, which we're in now, is the challenges that remain, especially with regulatory framework. And you now have what I would say is like the relationship between traditional finance and cryptocurrency, where you're seeing a lot of ETFs come out and products related to digital currencies. Like you have a lot of stable coins, and it's an evolving ecosystem with an ongoing dialogue that needs to be had, and with the exploration of potential opportunities and risk. There's a lot of risk involved. A good one, look, we mentioned Trump's affiliation with crypto and his meme coin that came out. There were a lot of millionaires that we made. And I know there was talk about, I think the top, I don't know, I'm not quite sure, but the top users had to, were going to be invited to meet him for dinner. That's pretty special. Now, so to proceed, we'll cover the basics, and I'll be going on to that next. To proceed, let's get everyone covered with the basics. And there are people who are probably watching who don't understand or don't know what a cryptocurrency is or digital asset is. And I think it's only right that we get everybody, up to speed. And we're going to be looking at this document from the Basel Committee on Banking Supervision. It's the BIS. Like I said, like the central bank for central banks. They provide prudential guidelines on how to treat things that banks have to deal with. And for instance, now we have a lot of crossover from crypto into traditional finance. So this is prudential treatment of crypto asset exposure. So it's basically telling the banks, what to do when they have crypto assets and how to treat it. So this is something you can check out. Just go to the BIS website and you can get more information about this. Now get to the good stuff. I think that's on page 5. And I'll read this and provide definition. So it says in June 2022, the Basel Committee on Banking Supervision issued its second consultation on the prudential treatment of banks' exposure to crypto assets. After considering the feedback from stakeholders to the consultation, the committee has now finalized its prudential standard, which has been endorsed by the committee's oversight body, the Group of Governors and Heads of Supervision. This document sets out the final standard, which the committee has agreed to implement by 1st of January 2025, and this is May 2025. So, and this is quite relevant. And if there are any other updates to this, that would be wonderful. But this is a good place to start. Now, so what is a cryptocurrency? Now, according to this paper, I don't quite call it cryptocurrency, but call it crypto assets. So, according to the BIS, which basically sets the global standards for banking regulation and the required regulatory guidance on how cryptocurrencies should be treated. Crypto assets are defined as digital assets that use cryptography for security and are not issued or guaranteed by the central bank or government. They are decentralized and typically rely on the distributed ledger technology, such as a blockchain. The document goes on to outline, the prudential treatment for a bank's exposure to crypto assets. There's the finalized standard to be implemented in January 1st, which is pretty important. The framework, requires the banks classify. You can see here that banks typically classify crypto assets into two groups, and the first group being for lower risk, assets, what they deem as lower risk, including things like tokenized traditional assets, stable coins, like I mentioned, USDT. So like a USDT is like, it's like a dollar equivalent, but it's a crypto asset. So you can have USDT, USDC, and they're typically always sort of backed by actual dollars. So that's group 1, lower risk, and group 2 has higher risk, and these are assets, crypto assets that don't quite meet the group 1 conditions. And we have things like unbacked crypto assets. Now the standard details the capital requirements for each group, including infrastructure risk, add-ons for group 1 and group 2 exposure limits, and updated rules for liquidity, leverage ratios, and large exposure. And this is important because this now sets the ground rules for a seamless integration of crypto assets or cryptocurrencies into traditional finance. Provide more information as to what a crypto is, the key concepts. Okay, so to provide clarity, I would go over key concepts that you need to familiarize yourself with, so that it makes sense when we're going over this topic. So good examples for cryptocurrency that most people sort of know about, you have Bitcoin, you have Ethereum, and now the hot one nowadays is Solana. These are examples of digital currencies that use cryptography for security, and they operate on a decentralized network and called blockchains, which means they're not controlled by any central authority or government or bank. Now, if you remember the BIS explanation, the same keywords that you noticed there, things like blockchain, decentralized ledger or networks, cryptography for security. Now, over the past decade, crypto has gone, from something that's been niche interest to a mainstream phenomenon. In the US, millions of people now own some form of cryptocurrency. major companies like Tesla or PayPal, they've embraced. We now have Coinbase in the US, helping US citizens get their hands on crypto and be involved in the space. With the rapid growth of crypto, there's a lot of challenges that come with that for policymakers. And as for understanding what crypto is, the key concepts that I think we should cover. For the key concept, you have things like peer-to-peer transactions. Peer-to-peer transactions. And crypto enables transactions between individuals without the need for intermediaries. So when you hear people talk about peer-to-peer, they're basically saying I can send you money, you can send me money, and you don't necessarily need an intermediary like a bank or credit union or anything like that. So it's decentralized. So for crypto, a good example is Bitcoin. There's a network and it operates independently without a central authority or a single point of failure. In fiat system, you have your central bank, and then you have your banks, and then there's a network that there's a central authority. But for crypto, it's pretty decentralized. Everybody operates independently, and because there's certain mechanisms that ensure that it works, which we'll come to in terms of proof of work or proof of stake. Everybody so that ensures the system works, and there's no central authority that says we can stop you from doing this because you don't meet certain criteria. And now you have cryptography. This is secret cryptographic techniques that ensure that the integrity and security of the transactions are authentic, and they go through. So you have the blockchain. Transactions are recorded in the blockchain, in the public blockchain units, and they have what they call like the immutable ledger, called the blockchain, and it ensures transparency and prevents double spending. So I can't spend, for instance, my Bitcoin or my USDT or my stable coin and spend it a second time. All right. So now there's a mechanism that these blockchains have that ensure that it works. It's what they call like a consensus mechanism. In Bitcoin, I believe, is proof of work. Certain other cryptos, you have what they call proof of stake, and I'll briefly just sort of explain that and we move on. And so the proof of work is a consensus mechanism that ensures it secures the network and provides incentives for participation by group of people that we call miners, and they earn rewards when they verify transactions. Also, what you have mentioned, which is an alternative to proof of work, which is a consensus mechanism, is something called proof of stake. It relies on validators. These are like miners to stake, or when you say stake, it's like you lock up your cryptocurrency, you keep it somewhere, a certain amount of cryptocurrency to participate in validating transactions and creating like new blocks. Now, these validators are chosen randomly, and they often stake or lock up a certain amount to validate blocks, and they earn rewards in form of fees and the likes. Now, no one really knows which is better in my opinion. Some people say like, proof of stake is less energy efficient than proof of work. We're yet to see, which mechanism sort of outlast the other. Now, in a bit, not to get too technical, the high level summary of how this works is you have transactions, users create digital signatures, and these transactions are verified by miners. These miners, in verifying transactions, they create what they call block creation. Miners compete to solve complex cryptographic puzzles, and they get rewards in terms of high fees, and bitcoins are created. So that's sort of it's technical, but what I would say, if you're interested in learning more about what a crypto is, you can go to Khan Academy. It's pretty free. Just type in blockchain, and you get a lot of in-depth knowledge on cryptocurrencies. Having considered why crypto is so important and so disruptive, let's also consider why it's so hard to regulate. We're considering right now the regulatory landscape and trying to find out who's in charge. And one of the biggest challenges in the US crypto landscape is figuring out who's in charge. What regulator is in charge? Unlike traditional financial systems, which are clearly regulated by agencies like the SEC, that's the Securities and Exchange Commission, or the CFTC, Commodities Futures Trading Commission, crypto exists in the gray area. And I know that sounds funny. For example, is Bitcoin a currency, a commodity, or a security? And the answer to that question will depend on who you ask. The SEC tends to view many cryptocurrencies as securities, while the CFTC classifies Bitcoin as a commodity. Not just federal agencies, states also have their own rules. So you find out that this overlap creates confusion for businesses and consumers alike. Now, we have to address the point that I made, by saying that crypto exists in a gray area. And this is due to significant regulatory fragmentation that exists in the US in certain sectors, particularly in the banking sector. And we can see how that's playing out in the crypto landscape. And I remember coming across this when I was doing my master's in central banking. We're doing, I think was the first course we're doing, I believe it was comparative central banking. We're looking at central banking in different countries and trying to compare and find out what works in the different regimes. And when we got to the US, I noticed like the US had so many regulators in charge of the banking sector, and that regulatory fragmentation is why we have such a challenging time regulating crypto. And I believe we'll come to that in terms of the new updates we have with the executive order by the president, Donald Trump. Now, so we see regulatory fragmentation being the problem why crypto exists in a gray area. And regulatory fragmentation, I'll just quickly provide a brief, I won't call it a definition, but a brief explanation of what regulatory fragmentation is. It refers to a situation where you have multiple regulatory bodies overseeing the same or related industries, often with overlapping, inconsistent, or conflicting rules and responsibilities. This can lead to complexity, inefficiency, and challenges for the entities or institutions being regulated by the regulator. And the truth is, with fragmentation, you can get extra checks and balances. Oftentimes you do, but it comes with unintended inefficiencies and potential risks. Now, the US banking sector, like I mentioned, is a classic example where you find regulatory fragmentation. And the main actors, for instance, you have federal regulators, of which you have the OCC, you have the Federal Reserve, you have the FDIC, you have a CFPB, and for state regulators, I believe you have, state banking authorities, adding extra layer of regulation. You also have specialized agencies like the SEC, the FinCEN for anti-money laundering, and the NCUAs for credit unions. One might ask, why do you need all of this? And the truth is, the reason why you have this is for historical reasons. For example, in the US, they've had regulation that had to keep up because of different crises that evolve over time. You've also had political and institutional inertia that has ensured that this fragmentation has stayed. And really the consequences of regulatory fragmentation is you have complex compliance, you have regulatory arbitrage, situations where institutions shop for the regulator that is most favorable to them. You have gaps and overlaps in regulation. You also have slower response to innovation. I know, like in the US, the banking system did try to remedy this with the Dodd-Frank Act of 2010. Crypto and fintech has sort of fallen into, the cracks with regulatory fragmentation, where the SEC is trying to take point. You also have the CFTC. So, we don't quite have a clear regulatory framework, and I believe the executive order by the president is working on that. We'll get to that. So you find that for crypto, you have new financial technologies often fall into regulatory gray areas with different agencies claiming jurisdiction or none at all. So that's why we have a situation where crypto appears to be very difficult. Regulatory fragmentation aside, it's important to understand that crypto and the regulation of crypto is constantly evolving. And regulation from a state stance or perspective can shift. However, here's a general overview of some states considered pro-crypto and anti-crypto. I wouldn't like to use anti-crypto. I would say crypto-friendly and less crypto-friendly, along with reasons why, they have been classified as such. So for crypto-friendly states, you have Wyoming. Wyoming, for instance, has been a leader in creating a crypto-friendly regulatory environment. The reasons being that it has clear and favorable regulatory environment for crypto businesses. They pass numerous pro-crypto laws, including recognizing decentralized autonomous organizations called DAOs as legal entities. They also have favorable tax policies for crypto. Florida, the reason being Florida has been actively seeking to attract crypto businesses with no state income tax and crypto-friendly policies. Cities like Miami have embraced cryptocurrency, and they've also worked to streamline regulation. Texas, the reason being Texas has become a hub for cryptocurrency mining due to its relatively low energy cost and favorable regulations. And they've also authorized state chartered banks to offer crypto custody services. Colorado, for instance, has shown willingness to integrate cryptocurrency into government function, such as allowing residents to pay state taxes with crypto. They're also working on blockchain innovation. New Hampshire, for example, has favorable tax policies for crypto investors and businesses, with no taxes on capital gains. I think that's amazing, no taxes on capital gains. And they've also exempted crypto businesses from money transmission regulations. Now, these are less crypto-friendly states. Top of the list is New York. And the reason being, New York has a bit license requirement, and it's known for its strictness. And I can understand why states or regulators want to be strict. And this bit license has, deterred some crypto businesses from operating in the state. And there's a regulatory body, and it's considered quite high in New York. For clarity, the bit license is a business license for virtual currencies, for virtual currency activities. It's issued by New York State Department of Financial Services, the NYSDFS. That's a mouthful. Virtual currency business activities cover various actions, including transmitting virtual currencies, storing or holding virtual currency on behalf of others, buying and selling virtual currencies, performing exchange service, controlling, administering, or issuing virtual currencies. Now, the second state that's less crypto friendly is California. And the reason being, California has implemented strict crypto regulation frameworks that have been compared to New York's bit license. This has also caused, this has also been it's a source of concern for the crypto community. Hawaii has had a history of strict regulation regarding virtual assets. While they are recently making improvements, they've also been historically considered a state with difficult regulatory environment for crypto businesses. Now, I will just quickly talk about the factors influencing a state's position, and try not to get too technical. I'll just name them. One being economic development. Some states see cryptocurrencies and blockchain technology as opportunities for economic growth and job creation. That's why you might have states leaning into favorable regulation. We also have regulatory concern. There are other states that prioritize consumer protection and financial stability, which will probably lead to stricter regulations. And that's why you probably see New York come out with the bit license, and California also, having strict rules. You also have technological innovation. Some states are focused on fostering innovation in the blockchain space. For key example, Florida with trying to make Miami a crypto hub. You also have favorable tax policies. States favorable tax policies, such as no state income tax, are more attractive to crypto investors and businesses. Now, it's important to stay informed about the latest developments in crypto regulation, as it is a rapidly changing field. Honestly, the patchwork of existing regulation makes it difficult for the crypto industry to thrive, while also protecting consumers and preventing fraud. I think that's important to note. So what's being done to address this? So we just drill down on the current crypto landscape. The banking system is heavily regulated for a lot of reasons, and one of which is to ensure that the payment system doesn't fall apart. Now, crypto, as I mentioned, is transitioning into being integrated into the existing financial system, and that's the reason for a lot of strict regulation, a lot of regulatory oversight because of the fragmentation. Now, the US crypto landscape is currently in a state of flux, and it's marked by significant uncertainty, as crypto regulation in the United States, like I mentioned, is a patchwork of federal and state laws focusing on consumer protection, anti-money laundering, and financial stability. And quick breakdown is you have a lack of comprehensive federal framework. There is no single overarching federal law specifically governing cryptocurrencies. I mean, efforts have been made, and we'll cover that. But just to point out, there is no comprehensive federal framework. And we also have legislative efforts. Congress is exploring various legislative proposals aimed at creating a clearer regulatory framework, but progress has been slow, and we'll touch that as well. And we'll also look at, the executive order by the president. So we also have, and I mentioned this earlier, this current BIS research on CBD, and you might have spillover concerns, and I mentioned, we talked about this before, the BIS 2022 survey of 86 central banks, with 94% reportedly being engaged in some form of CBDC work. And it's highlighting the importance of a comprehensive framework for the regulation of crypto assets. Now, the key points from all of this is there's a lot of uncertainty. The lack of clear rules creates significant uncertainty for business to operate in the crypto space. And we also have innovation challenges. The current regulatory environment may stifle innovation and hinder the growth of crypto in the US. You also have investor protection. The primary goal of regulators is to protect investors, but the current approach where there's a patchwork of regulation with the federal states, and you're not quite sure what you get, depending on where you are, may not be the most efficient and effective way, to achieve this. And speaking of investor protection, a lot of people who are interested in crypto and they try to put their money there and they get burnt. So it leaves a lot of investors with a bad taste, for the sector. Just to quickly run through the different types of regulation we have with the federal, the state. And so for federal regulation, the regulatory agencies we typically have seen so far is the Securities and Exchange Commission, the SEC. It regulates cryptocurrencies classified as securities. We've seen the approach where, they typically do regulation by what's the word now? By litigation, right? We see recent cases involving Ripple. I think they also went after Coinbase. They also went after Hex. And funny thing is, for the Ripple case, I wouldn't say they lost, but they didn't quite win. For Hex, I think they've also dropped that as well. So we see the SEC is focused on specific tokens classified as securities on the Howey test. Their approach of using legislation hasn't quite worked, and hopefully with the executive order that we'll touch, they come out with something really, really positive. And we also see the CFTC, the Commodity Futures Trading Commission, and they oversee cryptocurrencies considered commodities such as Bitcoin and Ethereum, and regulates derivatives like futures contracts. They're cryptos that have a platform where you can actually trade derivatives of futures, and that's pretty sweet. So we also see the FinCEN, which is the Financial Crimes Enforcement Network, and it enforces anti-money laundering and know your customer, which is KYC requirements, classifying exchanges and wallet providers as money services businesses. And that's also important. And I think there's a recent case where Binance got fined in the US, and it's good because crypto initially had a bad reputation when it came out, because people said, oh, it's what you use to carry out transactions on the dark web, and it just made everybody who had something to do with crypto seem shady, because it made it seem like you were doing money laundering. But it's good to see some form of regulation for anti-money laundering and know your customer. We also have the IRS, to treat cryptocurrencies as property for tax purposes, requiring reporting of gains, losses, and transactions. And just for a quick rundown of development, like I mentioned, it's a space where there's a lot of change. So a lot of things I might be saying might have been overtaken by events. One of the major events is the executive order by President Donald Trump. But we see key developments where we had President Biden 2022 executive order, which called for a comprehensive federal approach to regulating digital assets. We also have exploring the potential benefits and risks of CBDCs by the Federal Reserve. And I believe I'll just, show that now. All right, so this is the Federal Reserve website, and just showing that there's research by the Fed, even though it's something that, the US historically, if you look at a lot of the attempts at regulation have spoken against. They don't want a central bank digital currency. However, the Fed has done some research on it. Now, it says, while the Federal Reserve has made no decision on whether to pursue or implement a central bank digital currency or CBDC, we have been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation. Our key focus is on whether and how a CBDC could improve on an already safe and efficient US domestic payment system. And I think this just makes sense, because as much as the US isn't trying to head in that direction, it's good to explore, what are the possible benefits and risks of having a CBDC, so you're informed. And I think that's worthy of applause. I mean, the SEC basically should be applauded for that. So, just to quickly, since we're talking about federal regulation, it's good to point out, some of the loopholes. And what I want to highlight is the overlapping jurisdiction. So the SEC claims jurisdiction over cryptocurrencies deemed to be securities, requiring registration and adherence to security laws. The CFTC may regulate cryptos as commodities if they meet certain criteria. Other agencies like the IRS, taxes crypto transactions. FinCEN implements anti-money laundering. And because of this overlapping jurisdiction, you find out that the SEC might classify a particular crypto as a security, the CFTC might classify it as a commodity, and then you now have, ongoing legal battles. Like I mentioned, the SEC has been increasingly assertive in its enforcement actions against crypto companies, leading to numerous lawsuits. And I mentioned Ripple, which I believe they lost. I know Hex, I believe they lost that as well. I know they had something against Coinbase, but I think Coinbase sort of wiggled around that and got approvals and went ahead. So these are things that one has to consider when you're looking at federal regulation. Now, for state regulation, you have states. States have a diverse approach, and we've noticed like varying degrees of crypto specific legislation. And we looked at the crypto friendly states and the less friendly states. It's the same thing. Like, it's a patchwork of rules at the country where we now have pro crypto, and I wouldn't like to say anti crypto, but less friendly crypto states. And just a quick mention, we have New York with a strict bit license framework requiring businesses to meet compliance standards. We have Wyoming, which is a crypto-friendly state offering regulatory framework for crypto banks and DAOs. We have many states, adopt, and I think it's something that I would like to mention, many states adopt the Uniform Law Commission's Virtual Currency Business Act, or apply money transmitter laws to cryptocurrency activities. And these laws were originally designed for traditional financial services, for example, wire transfers, check and cashing. However, these laws often lack the explicit provision for virtual currencies or digital assets, leading to inconsistencies across states. Also, what you have mentioned is the risk crypto businesses face because some states do not have a formal position on virtual currencies. Instead, these crypto companies have to make their best assessment of requirements by analyzing court rulings instead of consulting regulations. This is why a comprehensive crypto framework is needed. And so current challenges, like I mentioned, clarity of classification. We have ongoing debate over whether certain digital assets are securities, whether they are commodities or something else. We also have stable coins, it's a current challenge. It's growing. So regulators, regulatory attention, focuses on ensuring transparency and reserves with proposals to treat them like, bank-like assets. Typically, stable coins are backed by either dollars. Some make attempts to, have maybe like something like gold to back them, and it's a current challenge and they're really growing fast. So you need a comprehensive framework to sort of put guardrails as to what is a stable coin, what's required for having something to back that. So we also have decentralized finance, which is very popular now, is DeFi. And we have the lack of a centralized entity, it challenges traditional regulatory approaches. Another one is also global coordination. As crypto markets operate internationally, harmonizing US laws with global standards remains very complex. So you find out that, there's a lot of regulatory arbitrage. Companies operating in certain parts of the world might find it difficult to have customers in the US, or customers in the US with certain laws might find it difficult to carry out business somewhere else in the world. So that global coordination, I believe, would come when we have a comprehensive crypto framework in the US. Let's talk about some of the key policy issues surrounding crypto. First up, we'll look at security and fraud. Cryptocurrency are often targeted by hackers, and scams like Ponzi schemes and rug pulls, they are unfortunately common. A very recent one is the Coinbase hack, where Coinbase says hackers bribed staff to steal customer data and are demanding $20 million in ransom. Coinbase has responded, and the regulators are trying to respond to the hack as well. Back to Coinbase, it's a fun one to keep up to date with. But also, it's important to mention that the current crypto landscape is at a critical juncture, with governments and regulators worldwide grappling to oversee this rapidly evolving industry. And in the United States, there are new attempts at regulation, and we'll come to that with the president's executive order on crypto. And it's gaining momentum. However, there are also other regulatory attempts that have been made, and we'll like to cover that. These attempts have been made to bring clarity and stability to the market, and we'll like to cover that before we get to the Biden administration released an executive order on digital assets, calling for a comprehensive framework to address risk and harness the potential of cryptocurrencies. And we had key legislative efforts such as the Gillibrand Responsible Financial Innovation Act, also known as the RFIA, and we can see a little bit on that shortly. that it proposed creating clear guidelines for regulatory clarity, crypto taxation, consumer protection, stable coins, interagency coordination, and the classification of digital assets. However, the bill has faced challenges and criticism, such as the possibility of the bill creating overlapping jurisdiction between the SEC and the CFTC, which might lead to regulatory conflict amongst regulators and adequate coverage for the environmental impact of crypto mining. That was also something that was criticized. There are also those who still think the bill needs work, particularly in addressing finance, which is DeFi platforms and stablecoins. Now, this particular Gillibrand Responsible Financial Act is still under consideration in the United States Senate as of May 2025. And just a quick look on congress.gov. If you put the bill in, you see that still with the Committee of Banking and Housing and Urban Affairs, they held, and it was read twice, but nothing has really come out of it. And I don't really think, and this is my opinion, I think this bill somewhat is dead, and that's just my own take with the new executive order that I will speak about, and that's just what I think. It does have some really good things that I would love to go deep on, but I think it's best to focus on the executive order. But I just want us to touch a little bit on this. All right, so the bill is still under consideration. It was reintroduced in July 2023 and referred to the Senate Finance Committee with hearings held in October 2023. There has been no indication that the bill has advanced beyond committee or been brought to the full Senate, and this is why I think it's probably dead, because of the executive order. And we have recent reports, confirmed that the act awaits consideration in the Senate and its future remains uncertain, as it has not yet passed or been enacted into law. You can check information on Congress.gov. It shows that the bill has remained with the committee phase, and that's the Committee on Banking, Housing, and Urban Affairs. I also like to point out that just to keep up to date, on policy issues, you can always check congress.gov. The website provides official legislative information, including bill text and state status updates. You can also check Legiscan, I believe. That's legiscan.com. It's a website that provides very detailed tracking information on bills. I think that's important to point out. However, it's important to point out that President Trump's new executive order on cryptocurrency does not notify the Louis Gillibrand Responsible Financial Innovation Act. The executive order primarily revokes Biden's era directives, notably Executive Order 14067. It prohibits federal agencies from establishing or promoting central bank digital currencies and establishes a new working group to develop a federal regulatory framework for digital assets. The Louis Gillibrand Act, a legislative proposal in Congress, is not directly addressed or overridden by these executive order, which focus on the executive branch policy and regulatory guidance rather than nullifying or repealing congressional legislation. I just need to point that out. However, regulators are working to solve on these issues because it's a tough balancing act. The main question is, how do you protect customers without stifling innovation? Speaking of innovation, crypto has the potential to revolutionize finance. Decentralized finance, or DeFi, as people call it, allows people to lend, borrow, and trade without intermediaries like banks. But this also raises questions about oversight and accountability. Another reason why we need a comprehensive legislative framework on crypto. Another hot topic is stablecoins. Cryptocurrency that are pegged to stable assets like the US dollar. These are seen as a bridge between traditional finance and crypto. But they've also raised concerns about financial stability, especially after the collapse of Terra USD in 2022. In May 2020, I believe, it stands as one of the most significant failures in cryptocurrency history, raising around approximately, I believe, $45 to $50 billion in market capitalization within days and sending shockwaves through the broader crypto ecosystem. And let's not forget about the environmental concerns around or associated with mining cryptocurrency. For example, Bitcoin consumes a massive amount of energy, and it's also led for calls, for sustainable practices in the crypto ecosystem. And these are things that a comprehensive legislative framework would bring about, and let's be hopeful that the executive order does achieve that. And the United States has approached the supervision of cryptocurrency industry primarily through regulatory framework that has involved the federal state agencies, each overseeing different aspects of the ecosystem. We talked about this, the SEC leading the role by regulating cryptocurrencies that they deem as securities, enforcing compliance with existing security laws to protect investors and maintain market integrity. We also see the CFTC overseeing crypto derivatives and commodities, treating certain cryptocurrencies like Bitcoin as commodity. The FinCEN, which is the Financial Crimes Enforcement Network, focuses on anti-money laundering and combating financing of terrorism, requiring crypto exchanges and wallet providers to adhere to strict reporting and record-keeping requirements. Additionally, state-level regulators such as the New York State Department of Financial Services (NYDFS) have implemented their own licensing regimes, like the BIT license, to ensure consumer protection and financial stability. So this, and I talked about this already, but you see a multi-agency approach that aims to balance innovation with risk mitigation, though it has also led to criticism over regulatory fragmentation and uncertainty in the rapid evolving crypto space. Now, as regards policy implications of this regulatory moves, they're quite profound. As government seeks to, like I mentioned, balance innovation with investor protection, the next steps will likely involve closer collaboration between regulators, industry leaders, and policy makers. So the key areas to watch include the potential creation of a federal regulatory body for crypto, the treatment of CBDCs, and the enforcement of anti-money laundering and know your customer requirements. For individuals and businesses, I'd say stay involved by means of participating in public crypto discourse. I'd say engage with industry groups, choose your choice. There's the blockchain association. Engage, try to find out what's going on, keep abreast with development in the space, follow trusted sources, and educate yourself. Like I mentioned, you can go to Khan Academy, and they offer free courses on blockchain and cryptocurrencies. So stay abreast on what's going on. Despite the promise of effective regulation, there's certain risks that still remain for investors and users in the crypto space. There's market volatility, for example. We have security breaches, for example, I mentioned the Coinbase hack. We have regulatory uncertainty, and continues to pose challenges, in the space. To protect against these risks, individuals should adopt best practices, such as using a hard wallet for cold storage, enabling two-factor authentication with your crypto wallet when you're having crypto transactions, and you diversify your crypto holdings. Additionally, I'd say stay informed about scams, and fraudulent schemes. It's pretty essential because there are a lot of scams in crypto, so you have to stay abreast as to what's going on. I know the Federal Trade Commission has a guide on crypto scams. I think that's something you can look into. And as the crypto landscape evolves, it's good to stay vigilant and proactive with engaging with the space. Now, let's look at some of the recent developments in the US crypto landscape. In 2023, the Biden administration released an executive order on digital assets, calling for a coordinated approach to crypto regulation. This was a big deal because it signaled that the federal government took crypto seriously. Congress has also been active, with several bills introduced to clarify the rules around crypto. For example, the Lumis-Gillibrand bill aims to create a comprehensive regulatory framework for digital assets. But progress has been slow, and the industry is still waiting for clear guidance. Meanwhile, other countries seem to be moving fast. The European Union, for instance, recently passed its Markets in Crypto Assets, which is MiCA regulation, which provides a unified framework for crypto assets across the EU. Now, leadership in monetary payments innovation is something that I find very important on this topic. And I was so happy when the executive order came out for crypto by President Donald Trump. And the White House also has something here, presidential action strengthening American leadership in digital financial technology. It's good to see that the US is taking leadership in terms of digital financial technology, and because it highlights the importance of global competition for leadership in digital currency, in the digital currency space rather, and its implications for global payment system. The existing one, that we have from the Bretton Woods, and the potential impact on the existing international monetary system, because the US is the global reserve currency. Considering that crypto has the potential to revolutionize finance and payment system, it would only make sense naturally that the US maintains its global reserve currency status by taking leadership in the digital financial technology. And just to quickly read something that we have here from the White House. This is dated January 23, 2025. It says, by the authority vested in me as president, by the Constitution and the laws of the United States of America, and in order to promote the United States leadership in digital assets and financial technology while protecting economic liberty. And I like that. It is hereby ordered as follows. You could go check this out. I'm not going to read everything, but just see on purpose and policy, the digital assets industry plays a crucial role in innovation and economic development in the United States, as well as our nation's international leadership. It is therefore the policy of my administration to support the responsible, and I like that, responsible growth of the US digital assets, blockchain technology, and related technologies across all sectors of the economy, including by, these are different things. And it even has a definition of digital asset, which is great. It talks about Central Bank Digital Currencies. And I think this is the right step in the right direction. So what's next for the US? Will we see more clarity in the coming years? And how will this impact the global crypto market? These are valid questions. And for now, the most significant recent development in the crypto space, from a public policy perspective, is President Trump's new executive order on cryptocurrency. This executive order marks a major shift in US digital asset policy, aiming to make the US a global leader in crypto innovation and regulation. And we'll take a look at that shortly. The most recent development in the crypto space in the US is the executive order by President Donald Trump. We see the fact sheet by the White House here, executive order to establish United States leadership in digital financial technology. And we will take a deep dive in here and just, read most of what we need, to know. So he says, ensuring US leadership in digital financial technology. Today, President Donald J. Trump signed an executive order to establish regulatory clarity for digital financial technology and secure America's position as the world's leader in the digital asset economy, driving innovation and economic opportunity for all Americans. The executive order, I guess I should highlight what I'm reading. The executive order establishes the Presidential Working Group on Digital Assets to strengthen the U.S. leadership in digital finance. The working group will be tasked with developing a federal, I guess this is probably confusing. The working with developing a federal regulatory framework for governing digital assets, including stablecoins, evaluating the creation of a strategic national digital asset stockpile. The working group will be chaired by the White House, AI and crypto, and include the Secretary of the Treasury, the Chairman of the Securities and Exchange Commission, and the heads of other relevant development agencies. And I think this was something that I like when I saw. Because we mentioned regulatory fragmentation. This brings everyone together, right? So that you don't quite have certain regulators acting a certain way and others acting, and they're not necessarily speaking to each other. I think this is really commendable. The White House AI and crypto czar will engage leading experts in digital assets and digital markets to ensure that the actions of the working group are informed by expertise beyond the federal government. And this is also important because a lot of times you find, people who think they're smart and, people who are in regulatory positions and they don't quite get feedback from people who are really experts in the field practically. And I think this is also important as well. The executive order directs departments and agencies with identifying and making recommendations to the working group on any regulations and other agency actions affecting the digital assets sector that should be rescinded or modified. And I think this is great. It just shows that you have a working group that is willing to listen and willing to take input from any agency. And I think that's also important as well. We see the executive order prohibits agencies from undertaking any action to establish, issue, or promote central bank digital currencies, CBDCs. And I think for people who, CBDCs are great, but there are people who are sort of wary or scared of additional government surveillance with CBDCs, because certain people think, oh yeah, if you have CBDCs, it can be programmable. The government can know what you spend your money on. The government can tell you to do certain things, and if you don't quite do it, they can sort of put a pause on your money. And I think that's also good for certain people who have those fears. The executive order revokes the previous administration's digital assets order and the Treasury Department's framework for internet engagement on digital assets, which suppressed innovation and undermine the US economic liberty and global leadership in finance. And so I think, that sort of, pretty sums up, some of the recent development we saw from the Biden administration. So just to read this on, it says eliminating regulatory overreach on digital assets and protecting American economic liberty. President Trump is fulfilling his promise to make the United States the crypto capital of the planet. And see, this is what I mentioned. You want leadership in the crypto space. It's evolving. It's almost 2 decades old, and you need, a particular country to just take the bull by the horn and lead this revolution forward. So President Trump will help make the United States the center of digital financial technology innovation by halting aggressive enforcement action and regulatory overreach that have stifled crypto innovation under previous administration. And this was what we had previously. The SEC, sort of conducted regulation by litigation. They went after, Ripple now is making headways. They went after Hex, and they went after, I think, they went after a lot of, crypto businesses, considered securities by just litigating against them, as opposed to creating guidelines that they can follow and everybody is sort of happy. So now we see President Trump's policy vision marks an unprecedented step towards welcoming in a new era for digital financial technology, one in which the President Trump's administration will work towards ensuring innovation thrives, regulatory frameworks are clear, economic liberty is protected. And this is, what everyone wants to see. You have clear regulatory frameworks. Everybody knows, what the guardrails are. They know what's expected, what's not expected. And, it says the growth of digital financial technology in America must remain unhindered by restrictive regulations or unnecessary government interference. And I think that pretty much sums it up. We'll just look at the key highlights for this executive order. A strategic Bitcoin reserve. The US will establish a strategic Bitcoin reserve, treating Bitcoin as a reserve asset. This reserve will be funded with Bitcoin seized, in criminal or civil cases, and the government will now sell these holdings. Other digital assets, that are being considered like Ethereum, which is called Ether, XRP, Solana, Cardano, seized by the government, will form separate digital asset stockpile with the Treasury authorized to manage these assets responsibly. I mean, we need more clarity as to how that Bitcoin reserve would pan out. But that's a welcome one from the US. There's regulatory clarity and task force. The executive order creates a presidential working group, and this is just taking what's here and in the executive order and just presenting the key highlights. So there'll be regulatory clarity and a task force. The executive order creates presidential working group on digital assets and markets led by the White House AI and crypto czar to develop a clear federal regulatory framework for digital assets, including stablecoins. And the stablecoins part is very important. People sort of sleep on it, but it's very important. Agencies are required to review and recommend changes to existing crypto regulations within set timelines. And I think that's important, set timelines. There's a ban on CBDCs. The order explicitly bans the creation or promotion of a US CBDC, citing risk to financial stability and individual privacy, but supports the growth of a dollar-backed stablecoin. I think that's important. The rollback of previous policies. The order revokes Biden's administration digital assets executive order and related treasury policies, signaling a move away from restrictive regulation and enforcement. So, we mentioned the looming Financial Response, Innovation Act. However, I do, suspect that the outcome of this working group will supersede what's already in that existing congressional legislation that's with Congress. However, they might take certain things that are there and make it better, and that's what we hope for. There's protection for blockchain activities. It affirms the right to self-custody, mining, permissionless blockchain transactions, and seeks to ensure fair access to banking services for crypto businesses, and that's great. We also have relaxed enforcement. The administration is moving towards a less aggressive regulatory approach, reducing enforcement action and provide more certainty for crypto market participants. These actions are intended to foster innovation, attract investment, and secure America's leadership in the digital asset economy. And I think that's perfect. This is what you want. You want a comprehensive framework for digital assets. Europe has certainly kicked the ball rolling, and America, I believe, is taking the bull by the horn and providing clear guidance as to what we need to see for regulation in the crypto space. Another, relevant development in the crypto space, and I think I've mentioned this before, but I think it's what you have mentioned, is the Basel Committee on Banking Supervision. The released prudential standards for banks, crypto asset exposures, effective January 1st, 2025. The standard classifies crypto assets into two groups, and I mentioned this before, based on risk. Group one, be assets with receiving a risk weighted capital treatment, and group two, assets subject to more conservative capital requirements. So the key changes from earlier proposals, for this particular treatment for banks is that, the earlier proposals included a flexible infrastructure risk add-on and modifications to exposure limits and hedging recognition. The document, that I presented earlier also details capital requirements for credit, market, operational, liquidity, and leverage risk associated with crypto asset exposure. Still on President Trump's crypto executive order working group. Let's just try and see what the update is. Do we have any update on this? We talked about, the timeline, policy shift. We talked a lot about this. And, I like this here. Just, shows us who's the special advisor for AI and crypto. That's David Sachs. Key agencies, the SEC, the CFTC, Treasury, Commerce, DOJ, others. We see what the main task is. We see what the timeline is. This is great because you can have a working group and nobody knows what the timeline is. It's 180 days for main report, so we're expecting a report by July 22, 2025. See what the policy direction is: pro innovation, regulation, clarity, no US CBDC, rollback on Biden era policies, and public input, public hearings, and industry consultation encouraged. And I think this is what you need to see. And just a quick one in terms of early action. I see this here. It says the SEC under new leadership has formed a Crypto 2.0 task force led by Commissioner Hester Pierce, focused on clear rules, realistic registration paths, and sensible disclosure framework. I think this is perfect. The administration is reviewing and may rescind or modify previous regulations that are seen as obstacles to crypto innovation. I think that's also perfect. Now you see the next steps, and I think this is where we'll stop on this executive order and move on to other things. It says the working group is actively gathering input and is expected to deliver its comprehensive report and recommendations by July 22nd. This will likely include detailed proposals for new legislation and regulatory frameworks, as well as guidelines for the potential national crypto reserve. And we will all be watching out. Finally, let's talk about what all of this means for you as a customer or investor. If you're thinking about getting into crypto, here are a few things you need to keep in mind. Number one is do your research. Not all cryptocurrencies are created equal, and the market is highly volatile. Second, you need to understand the risk. Crypto is still relatively new. It's probably like 16 years, but it's still relatively new. And it's not an unregulated space, but regulation is evolving. So be prepared for the possibility of loss of your investment if you do not do your research or your due diligence. You need to stay informed about regulation. Changing policy, as you've seen with the executive order, could have a big impact on the value and legality of certain cryptocurrencies. You need to also protect your asset. Use secure wallets and be cautious of scams. So speaking of wallets, I recommend, hard wallets. If you don't own the keys, you really don't own the crypto. So remember, crypto is not just a financial tool. It's a technology with the potential to transform industries. But with great potential comes great responsibility. It's a Spider-Man reference. For policymakers and individuals, we need to stay abreast and we need to stay on top of this and ensure that we carry the citizens and everyone involved so that we make a collective decision as to how we want to adopt crypto into our everyday lives and not just leave it into the hands of a few people. Now, in closing, the US crypto landscape is complex, fast-moving, and full of opportunities and challenges as well. As policymakers work to strive to make the right balance between innovation and regulation, as we've seen with the executive order from President Trump, it's up to all of us to stay informed and engaged. If you enjoy this episode, please share it with someone who is curious about crypto and public policy. And don't forget to subscribe to A Policy Brief for more deep dives into policies shaping our world. Thank you for listening, and I'll see you next time.